and we expect them to do the same in the current challenges. So if they want to invest because they think that there are opportunities in dry bulk, we will be there to finance them. That's our business.
Thank you, George. Mark, you're sitting on the other side of the fence. What's your comment?
Yeah, we're not a capital provider, so we just provide advice, and we do that at every part of the cycle. So.
Thank you. Thank you very much.
First of all, I'd like to thank very much Nikos Bonosis and his team for hosting this conference. It has been very well attended, very informative, and I hope it's the first of many. So many congratulations on as well, of course. So well done. Now, the topic I'm going to speak about is restructuring as a business and investment opportunity, and it may be a bit strange to be speaking about restructuring immediately after the finance panel. So you have the good, it wasn't even very good news, and you have possibly hearing worse news now. But it's a bit of a paradox because we'll see how restructuring can be used as a business and investment opportunity, and it's not. I won't view this from the perspective of advisors or lawyers for whom it is an opportunity. This is for the real industry participants. So in terms of where things stand at the moment, the current landscape, what do we see? We see that we've had long depressed shipping markets. This has led to falling cash reserves for companies. And at the same time, we see that traditional banks are exiting shipping. We heard a lot about this earlier. Or deleveraging. There's a lot of regulatory pressure on banks to either exit or to deleverage. So and at the same time, again, this was talked to at the panel before, that there is a lack of finance. There is a lack of finance to replace the finance which is coming out. There are fewer committed providers of finance in this space. So we're really facing a bit of a perfect storm, I would say, in the area. At the same time, with what's happening within the banks, we're seeing also that there's a lot of trading of debt. So funds are coming in to buy debt. Shipping used to be had a banking model which was based on traditional name lending, relationship banking. Now people are finding that their long-term lender, with whom they've done business for 20, 30 years, has been replaced by a fund which has a completely different outlook. Also, something which is fairly recent in this market, because it used to be almost, let's say, a taboo, is that with banks looking to leave the industry, there is more and more opportunities for owners to buy back their loans. And that was something which for many years was something that wasn't countenanced. At the same time, in terms of looking at the background here, we're seeing that there have been some very high-profile charter insolvencies which have hit the market, and the most recent example being Hanjin. And finally, there are certain companies, the most recent example being Toyser, who are looking, who have filed for protection from their creditors. So very briefly, before we look at the opportunities, what are the triggers for a restructuring? Clearly, the depletion of earnings and the cash reserves has an effect on the cash flow, the ability to service the debt. That's one of the key triggers, of course. But it's not only financial triggers which result in restructurings. Everyone knows, I think most people know, of the requirement to maintain the assets at a particular percentage of the loan. We're seeing over the last few years with the depressed asset values, a requirement to top up loans so that the loans are fully covered. It was mentioned in the panel before, there was reference to financial covenants. More and more ship lending in the last few years is on the basis of financial covenants. So This is particularly relevant for listed companies, but also for private companies with holding structures. So banks are looking at imposing various tests in order to maintain a loan. So these are triggers as well for restructuring. And we've seen this is particularly relevant for public companies, and we'll talk about this a little bit later. Again, another aspect which was a trigger for restructurings is that in the past, this isn't so relevant now, but loans which are done pre-Lehman, there used to be a requirement from many banks for part of the interest rate, or for all of the interest rate, for part of the whole period of the loan to be fixed. With the way that the interest rate environment has gone since then, we find a lot of owners have found that their loans, that these swaps are out of the money, and that also results in various triggers. Now, in terms of the opportunities, what resulting from a restructuring, what we found at the beginning of the cycle post-Lehman was that there was a lot of very quick restructurings which involved plasters, fixing plasters, or sweeping things under the carpet, kicking the can down the road. So they were very short-term waivers, not really dealing with the problems, because at that time the banks faced their own individual problems and weren't able to contemplate doing real restructuring. Subsequently, however, because this round of restructuring and with the continuation of the bad shipping markets, we have seen more real restructurings. And therefore, what we have seen is that where there are really effective and balanced and realistic restructurings, those are the ones which are a benefit to all the participants. So when I talk about balanced, there have been cases in the past where owners have just put their hands up and said, look, I can't or I won't put any more money in to this project. I have no more cash to put in. I'll dump the problem onto you, Mr. Bank. Those solutions which may have worked before are no longer working. Likewise, we've also seen other restructurings go the other way, where companies which went into big and complicated restructurings have now found that as their performance has improved, they found that their hands are tied and they're unable to make investments at a time when they want to take the benefit of the lower asset values. So there is a move now to have better and balanced and realistic solutions, whereby companies in some cases, they have to dispose of certain assets or investments, but which will help them to ride out the storm so that they're better prepared when the markets improve in the future, to be able to take advantage of that position and then be able to grow at that time. Now, in terms of what I mentioned before, in terms of the having funds and owners buying back debt and banks exiting the industry, that's another important feature, because through that ability, let's say an owner, whether through buying back debt or getting refinancing to buy back debt at a discount, means that it can reduce its level of debt to more manageable levels. It brings down the owner's break-even, and even though the new financing that an owner can get is now more expensive and the leverage is going to be less, nevertheless, overall, it improves the ability of an owner to tackle the existing market. What we're also seeing is that more and more now, it's becoming a condition of a restructuring that fresh equity comes in. So if owning groups are looking to buy waivers, get deferrals, banks are saying you have to put in fresh equity, and if a deal can be restructured in the proper way, then a company, through either reducing its debt, reprofiling its debt, makes itself more attractive for new investment, because you're looking then at a company which has got a better profile debt, and you're looking at investors who would come in at today's value. They're not going to come in at the investment value at which the original shareholder, or it could be the same shareholder, is putting in further money. But you can make yourself attractive that way for investment, whether your own or from third parties. One other, and this is also relevant particularly to publicly listed companies, that those companies which restructure and are able to deal with all the covenants, any covenant breaches, are able to extend maturities, they also become a more attractive proposition on the capital markets. So they can distinguish themselves from competitors because they have effectively a clean bill of health. In certain restructuring negotiations we've seen, where owners are either unwilling or unable to put in further funds, or there has, in some cases, there's been a breakdown of trust. What we've also seen is that in those cases, a bank may go to an owner and say, look, we can't continue with this on any basis. What we'll do is we'll give you the option to go and sell your asset or assets in the market. Effective, in a way, it's a semi-forced sale, but it appears on the market as though it's a private sale. So this gives, and this is usually tied in with forgiveness of debt. So the existing owner is told, if you go away and sell the asset, we'll forgive the balance of the debt, but that creates also opportunities for others to come in and buy assets in the market, and sometimes, if they're strong customers of banks, they are able also to be seen as the white knight, to be asked to perform the role of the white knight by the bank. So, and then another aspect which I mentioned before, because unfortunately we're running out of time already, is we've also seen another aspect, which is funds coming in, as I mentioned, coming in to buy debt at a discount. And what we've seen there is, in some cases, that funds have used this as an opportunity to buy up as much of the debt as possible and to create a debt for equity swap, and in that way take over certain companies. This is sometimes done in the context of a Chapter 11 or some type of other insolvency procedure, but this is another area where we have seen that funds have come in and through buying debt at a discount have been able to take over a company, or at least control the destiny of the company. And then finally, as I mentioned at the beginning, one of the, let's say, hot topics for a number of years has been the use of protective filings from creditors, particularly in the US Chapter 11. And where we've seen the success there has been where a company goes in, having done a deal with its creditors before going in. So these are called pre-packs or pre-packaged insolvencies. And those benefit companies, for example, which other than their bank debt have got maybe unsecured bonds, or they may have out of the money contracts, out of the money new buildings, shipbuilding orders, or if they have charter-in obligations at above market rates. They are able in those cases, with the consent of their bank creditors, to get rid of those contracts, to terminate those contracts with the approval of the court, and therefore come out at the other side as a leaner company, which is with much less leverage. Thank you very much.
Before you go away, maybe we have a few questions here, but I want to make one comment to just liven up with the audience here just now. You just mentioned about Chapter 11. Usual Donald Trump saying. How can you tell that somebody is reading Donald Trump's book? One basic reason how is because you could, every chapter starts with chapter 11. Secondly, what I'd like to mention is that, just a couple of comments. The word restructuring, I wouldn't call it a bad word in the dictionary, but for our real timers, who are cronies, we find that sometimes that has a certain amount of negativity. Because when you refer to about debt forgiveness and the white light appearing from over the horizons, it's usually when things have gone fundamentally wrong. So all I can say is that, you know, you are reminding us of the days where it's raining outside, because that's when one uses the word restructuring, or rescheduling, or renegotiating, because in fact the word renegotiation basically means it's an inference of a default of some shape or form. But as Captain Paleokrassas mentioned earlier, just a small point, since your lawyer's working with the banks, don't forget that shipping is a marathon, it's not a sprint, it's a long-term business. So effectively, when you are there to go and support your customers, or you are considering supporting a customer, make sure you look at the long term, because we're not looking for a quick buck down the corner. It's a long-term business. On that note, does anybody have any questions?
Can I just make one observation
Of course,
on your
yes.
comment?
Thank you.
Because I think, I think, well, I clearly didn't make the point well enough in the presentation, but I think that's the issue that, well, the position of the banks, I think, the way I read it, is that if you're committed to your business, if you put capital into your business, they will support you. You will get the support of the banks. There are exceptions, of course, because you have banks which are exiting and they have no interest in future business. But I think if there is real evidence of commitment and meeting halfway, then in those cases, what I've seen is that banks are willing to compromise because they're in the market, at least those ones which are staying, for the long term as well. Okay, thank you.
Thank you.
I will come to the end of this process.
No, I think, well,
your experience.
I mean, from my personal experience, what I've been telling people is that until the end of this, well, last summer, 16, that there was a balance in our office of the work we were doing between new business and restructuring. Post September the 1st, it's tipped to restructuring.
Oh,
Yeah.
it's going faster now.
Yeah. But then again, you know, don't forget that we are also, lawyers will always be behind the curve, okay? Because the commercial deals may be done, they come to us sometime afterwards. So we're not, you know, we don't follow the curve.
Yes and no.
Yeah. Okay. Thank you.
Thank you, Joe.